Hello again, I'm Aaron Johnson. I'm with the Dwayne Johnson Group and Bridger Financial Services, and I'm here with a third quarter market update. It's hard to believe that the year's almost over. We only have a quarter to go. But to just kind of get right into the review, the third quarter was a bit of a roller coaster with a heap of twists and turns. And after hitting yearly lows in mid-June, markets rallied strongly into July and the first half of August. This was based on what I believe was the market's flawed notion that the Fed would somehow pause their interest rate increases in September and basically signal an end to future increases. But as we moved into August, Fed Chairman Jerome Powell was very clear that rate increases would continue until the Fed achieved its 2% target inflation rate. The markets quickly sold off following that announcement, but as the quarter ended, markets once again rallied based on comments from Fed Chairman Lael Brainard that the Fed would eventually reach a point where increasing rates further would pose an uneven risk to the underlying economy. Markets took that one sentence to get back to the whole pausing of interest rate hikes narrative that they had used earlier in the quarter. Although we've seen a decline in the rate of inflation from the torrid pace that we saw in June, inflation remains stubbornly high. In fact, the only reason inflation has backed off is because oil has declined to around the mid to high 80s, down from $120 per barrel range. So that's good news for consumers, but it's also been about the only good news that we've seen on the inflation front. Food and staples remain elevated and continue to rise, with some categories in those areas reaching double-digit inflation rates. Some of the decline in the rate of inflation is natural now that summer is over and vacation season is basically done. People can stop traveling, but they can't stop buying food. Oil is a notoriously volatile commodity that can shift up and down on a dime. Plus, the decline in oil is largely driven by a drop in demand due to worldwide weakening economy conditions rather than an increased supply. The price of natural gas continues to rise just as winter is starting to come in, while Putin continues to wage war in Ukraine and appears to be more desperate by the day. He's already turned off natural gas shipments to Europe on several occasions this year. As I said, the quarter was a mixed bag. Gross domestic product, or GDP, in the second quarter was not as bad as it was in the first, but it was still negative. And for the third quarter, they're expecting GDP to basically be flat, but that number will come out on the 27th of this month of October. And so basically, they're not expecting any growth so far this year. Prices are high, but people are still spending. And markets have been holding up mainly because earnings have not been as bad. In my view, it's only a question of time before the consumer really starts to stop spending. And the Fed's interest rate hikes really kind of begin to take a bite. We saw the third interest rate hike of 75 basis points at the September Fed meeting, and the Fed still really needs to unwind a massive balance sheet. The market seems to go into convulsions as we see the 10-year Treasury get to 3.5%, and that's exactly where we are right now. Companies and consumers will face mounting hurdles as debt service becomes more and more difficult, and earnings and pocketbooks start to get pinched. Paradoxically, though, higher rates will lead to lower inflation, and people will have less money to spend on products because a bigger chunk of their money is going toward credit card balances and servicing loans. Higher interest rates will likely force companies to curtail their spending for the same reasons as I mentioned above, and may eventually lead to more increased layoffs, and that might be the next step. The Fed has stated that it's actually fine with unemployment rates going up, as it fights inflation. Generally speaking, though, unemployed workers and unemployed people tend to spend less in the economy. But this is what it might take. This is what it might take to tame inflation. But it will also drive us deeper toward a recession, or further into it, I should say. There has also been little help from the current administration in the fight against inflation, as more spending was just passed via the Inflation Reduction Act. And there was also a proposal to forgive student loan debt to the tune of $500 billion to $1 trillion, though the administration seems to be unwinding on that a bit. To curb inflation, we need the Fed and the administration to be working together to take money out of the system. The Fed increases interest rates to take money out of the system, but our current administration just passed the Inflation Reduction Act, which injects a bunch of money into it. So they're kind of counteracting what each other's doing. And as I said in the last time, that higher rates are going to lead to slower growth, and until elevated inflation is taming, we'll have a period of stagflation. The talk of a soft landing, I think, is something that I wouldn't put a whole lot of faith in right now. And I think, as Jerome Powell said, that we are headed for some pain. There will be a lot happening in the upcoming quarter, but I think it'll be more along the lines of things kind of settling down. The midterms could hopefully restore some gridlock in Washington, so that all the spending stops. Markets like gridlock. They don't like one party over the other to be in. They like that there's gridlock and a lot of laws don't get passed. We still have to face the prospect of a very difficult winter, though, from an energy perspective, and an exhausted consumer that may not step up and fork over money for the holiday spending. And my fear is that the Fed overdoes this and continues to tighten until year end. The challenge for markets is to read the Fed properly and then to work within a new reality. The problem so far this year is that the markets have completely missed that point. Should you have any questions regarding your current plan, your allocation, please give us a phone call. Our number is 951-244-6702. Again, 951-244-6702. Thank you and have a good day.